In this episode, I discuss what infinite banking is really all about. Whether you recently discovered the concept or have been practicing IBC for years, this episode will bring incredible clarity to what becoming your own banker can accomplish in your life. I'm Nate. I make sense out of money. This is Dollars and Nonsense. If you follow the herd, you will be slaughtered. As I mentioned in the introduction, this episode I think is going to be one of the most powerful and simple episodes that just gets lost. You know, if you've been listening to my show for the past 20 episodes or so, I'm actually making, I'm diving into a lot of the advanced things. And what I was concerned about was that we were missing the entire idea as a whole. So if you are brand new to the show, if you're brand new to the infinite banking concept, you just discovered it recently, or whether you've been a client with us for 20 years, and anywhere in between, I think this is going to be one of the most powerful episodes to pay attention to for the next 30 minutes. Partly I say this because I believe infinite banking is actually the ultimate in simplicity. If you simply understand what's going on behind the curtain at mutual life insurance companies and at banks. And essentially the decision, or what IBC is all about, becomes very obvious when you start from there. When you decide to start by looking on YouTube and learning about insurance company selection, direct and non-direct recognition, policy loan rates, dividend rates, guaranteed growth, policy structure, and that is actually your intro into the idea, that becomes a big problem, because then you commoditize a strategy, and it's not a commodity. And so when people start there, they're just buying a product because the product sounds pretty good, instead of actually believing in an idea and then basing their life around the idea, which I think makes sense to do in light of reality. Like, in other words, it's just simply the banking system is not set up to profit you the default way. It's set to profit banks the default way. And infinite banking just becomes the most obvious solution to get out of that system and start banking under a new regime that profits you immensely and far greater over time than anything the traditional banking world can offer. And it really is this simple. So we're going to dive into what the infinite banking concept is really all about. I think it's going to provide unbelievable amounts of clarity. Next week, in my next episode, I'm going to talk about more practical ways to implement infinite banking in such a way that you can start living life under this new banking paradigm. And there's going to be some new revelations in that next week episode. But let's go and dive in this one. Probably the most important thing you'll ever learn about is in this episode right now. So let's dive in. So what is infinite banking really all about? Here is, at the crux of the issue, there is a problem that exists in the banking world right now. There's a problem that we have ignored for a long time as a people, that banks have slowly created a monopoly on capital. And they have become the preferred capital warehouse for individuals and corporations. So if you own a business, or if you don't, and you're just an individual, the idea is that banks have presented themselves as the preferred place to build up, store, and deploy capital, when in reality, they are an extremely poor place to do that, objectively speaking. And essentially, the whole IBC system is going to be exploring a better alternative to building up, storing, and deploying capital. So here's the problem. This is how the banking system works as its default, and what we're trying to solve for. The idea is that as a bank, they go out. It's actually kind of difficult to start your own bank. By the way, you have to go through this very long, arduous process. You probably have to raise a whole bunch of capital to go build your own bank. But nonetheless, the banking world essentially says we're gonna raise capital to build this bank, and it's just gonna sit here, and that is going to be the backdrop to start accepting deposits. And we're not going to use any of our capital. The bank is not going to use any of its own capital. All they're saying is the capital is the backdrop to keep other people's money safe. So they have to have some capital in the bank. Otherwise, no one would deposit money. Go back and listen to the Silicon Valley bank crisis and all these banking crises that we're in. When the capital starts to shrink at a bank and they owe all these depositors money in deposits, then it becomes a big concern. So this is not the episode for that. But nonetheless, they keep capital. They accept deposits, and they don't actually move their own capital. It just sits here in very liquid instruments. By the way, BOLI, bank-owned life insurance, is a big piece of that capital, what's called Tier 1 capital, the money they don't loan, the money they don't lend out, that just sits there liquidly, safely, guarding against any sort of catastrophe that could cause depositors problems. So they keep their capital there. They then come and they say, hey, deposit your money with me. And essentially what a bank does, remember, like a grocery store, by the way, if we use that as an example, a grocery store is in the food business, right? A grocery store doesn't grow its own food most of the time. Most of the time it buys food at one price and then sells it to other people at a higher price, and it keeps the profit. That's pretty much just business 101 in almost any business. You have a cost to get the goods, and then you sell the goods at a higher price. And that's actually what banks do. But banks are not in the food business, of course, they're in the money business. So they are buying money from us and then selling it to other people. So they'll say, you know what, depositor, we need your money. We need you to come deposit money with us so then we can go lend it out. So we're willing to buy your money at 1%, 2%. It's a little higher now, but for the last 15 years, it's been atrociously small, 0% from the vast majority of them. And so they're essentially saying, we're going to buy your money at 1%, and then we want to then sell it to everyone else at 4 to 5%, or whatever it is, and we're going to keep the spread between it as our own profit. And this is how banking operates. So banks buy our money at one price and sell it to other people at a higher price. And they live very comfortably buying and selling our money. The reason why this creates a problem, though, is because it's a unique situation in the financial world where the banking institution itself is raising money from depositors and is then only deploying depositors' money that we have a rightful claim to. It's our money that's out and being lent out to all these various different individuals and businesses that banks lend money to. But even though it's our money at work, we receive a very small minority piece of the profit that the entire system generates. So the banks don't use their own money. They just let their money sit in BOLI, primarily. A lot of it is in bank-owned life insurance. So the owners, the people who started the bank, put in a whole bunch of capital. A lot of it buys BOLI, and then that just serves as a reserve fund to allow depositors to put money in, and then they go use the depositors' money to make loans, and they live handsomely on the spread. And that's the reality. The problem, as I'm bringing up, is that it's our money. There is no other thing in the financial world that we would buy into willingly that says, here, go take all of my money, go work with it however you want, and I am willing to take a very, very small piece of the overall financial pie. We normally don't want to operate like that. Like, in other words, and I've used this metaphor before, it'd be like depositing money into your 401k, and the 401k goes out and earns like a 50% rate of return, and you call them up and like, hey, how do we do this year? And the mutual fund manager on the other end of the phone says, we did great. We invested your money and earned 50%. Well, I'm like, wow, that's great. But he's like, well, given your account only grew by 3% and we took the other 47% as profit for ourselves, you'd be like, what is this? It's my money. You're taking my money. It's supposed to be for me. I understand that you need to get paid, but shouldn't my money be profiting me more than it is the person who's managing the money, per se? And so and by the way, this is why we don't like some other forms of investments. If you want to go back to my barbell analogy too, the barbell investing analogy, that was a few episodes ago, by the way. You also described those would be middle of the road, middle of the barbell deals, where essentially someone else has a lot to make and you have very little to make and you're taking all the risk. That's banking. The banks have a lot of money to make, very little risk, and you have very little money to make, and you hold the risk. Now, I know the FDIC may come in and save the day, but we'll see if that is actually a reality if there was a true banking run. That's not the scope of this podcast. So essentially, here's the problem that banks create, is that they have pitched themselves at being something that they're not good at, and they have got us to buy into that. Here's what they've pitched. They have pitched that they are a good capital reservoir. Like, in other words, that banks are saying we are a great place to store money safely, that you can build up your capital, both for you individually and in your company that you own. If you're listening to this and you own a corporation, that you can leave your money here, we'll keep it safe, and it's the best place to store up your capital that maybe you'll deploy one day. The reality is that's not what they're good at anymore. Maybe they were one day. They are not good at that anymore. I say that we ought to relegate the banks to only do what they're good at doing. The one thing that banks are good at doing is facilitating transactions. This is what banks are good at. A bank is good at facilitating transactions. In other words, we put money in and it's liquid and we can swipe a debit card, we can write checks. The only money that you should leave in a bank is the money you need to facilitate transactions. So that would be like 1 to 2 months of operating capital, both for you individually, for your own personal budget, and for your corporation. You should only leave in the bank the amount of money that is needed to kind of facilitate the transactions of the life, the overhead of your life, the overhead of your business, because that is actually what they're good at. They're a needed piece in society to facilitate transactions. The problem, though, is when we start using them as capital reservoirs. As in other words, all of my money is going into banks and it builds up there until I find a place to deploy it. This is where banks have created a monopoly that they're working in a space that they don't belong in and they're not good at, and it's hurting the American consumers and people across the world. So IBC stands in the gap. Infinite Banking says there's actually a different way to do this. Only use banks for doing what they're good at, which is just simply facilitating transactions. Open up a checking account, have your cash flow go through there, but get out, only keep in there what's needed to pay the bills, to do the things you're trying to do, and get everything else out of that system that doesn't profit you and into a system that does. The question is, what is the system? What is the system that's going to profit you, that works similarly to banking, but that makes you more money? And here's where we have to draw back the curtain that exists in front of financial institutions, because they don't actually want you to know what their inner workings are. There's a curtain out front, and they want you to commoditize things that shouldn't be commodities. It shouldn't be. But all that to say, let's take a look behind the curtain. And this is what Nelson Nash discovered when he wrote the book, Becoming Your Own Banker. He said, if you look at a bank and its business model, and then you look at a mutual life insurance company and its business model, you will discover that they are essentially the same thing. This is what you will discover. A bank and a mutual life insurance company are essentially in the same business. Banks, as we've already said, they take deposits from depositors. Maybe they promise them a little bit of interest, but that's not even what they're used for anymore. They're mainly trying to promote themselves as transaction facilitators, and they're trying to pay as little as possible on your capital, but that's neither here nor there. Let's keep going. So a bank is accepting deposits and maybe paying 1 to 2%, and then it is lending at 5-6%, and it's keeping the spread. And a mutual life insurance company is essentially doing the same thing. The only difference is the name out front. That's the only difference between the bank and the mutual life insurance company. So a mutual life insurance company accepts our deposits in the form of premiums, really. So the word is different, but it's the same mentality, that they're taking our premium dollars into this big pool of money that then just goes out and makes loans to it, to other people. Just like a bank. A bank is just a pool of money that accepts deposits and makes loans. A mutual life insurance company is just a big pool of money that accepts deposits and makes loans. And the mutual life insurance company promises to pay interest to its policyholders, to its depositors per se, to the premium payers, in the form of guaranteed cash value increase. But the big difference, here is where there's a big divergence. So all of them borrow money from depositors or raise money from depositors, lend it out, and make a profit. The question at hand is who gets the profit from that entire financial engine that's happening at the time. And inside of a banking world, of course, we know in the banks, they are not in existence to profit their depositors. In fact, we know that the less they pay depositors, the more profitable they will be. So who is the they in the banking world? The they in the banking world is whoever owns the bank, the shareholders of the bank. If you own like a small private family bank, then the profit will probably be sent to you as dividends and through on a K1, and you'll own the bank and you'll get a profit in cash flow. If you are maybe a big publicly traded company and you own stock in Bank of America or Chase or Wells Fargo or something like that, there may be less focused on dividend payments and more focused on all of that financial profit that's being made being reinvested into their business to increase share price. But it's the same thing. The entire financial engine is profiting shareholders of the bank on the backs of the depositors. It's all the depositors' money that's producing the engine. And the banks are just using the depositors to make a profit for somebody else. Here is where the divergence exists. In a mutual life insurance company, which is essentially doing practically the same things that a bank is doing, with the premium payments coming in and loans going out, same thing as deposits coming in, loans going out, creating a profit. The difference is, of course, who is the owner of the bank? Who is the owner of the bank? In a mutual life insurance company, there are no shareholders. You can't go buy stock in a mutual life insurance company. There's no private ownership, with some family that runs it. In a mutual insurance company, the idea of mutuality just simply means the policy holders are the owners of the institution. So what does this mean? This means the entire institution exists to make profit for who? Well, of course, it's the owners of the institution, which happen to be you and me. So the idea is, hey, you can use the banks. You can relegate the banks to doing only what they're good at doing, which is facilitating your transactions. And then you can take whatever is left, is what's called capital in this world, by the way. In the world of life, you have your expense money, which is like your checking account money. Whatever is not being expensed becomes capital. If you can remember from my one of my other recent episodes that you can go watch on YouTube, it's where I talked about how infinite banking impacts your balance sheet and your income statement. And I described this very thing, that your income statement is your income and expenses coming in. Whatever's left over automatically becomes capital and exists on the balance sheet. And here's what we're trying to say. The world of infinite banking is saying you only want bank account money to be what you need to facilitate transactions.
The conventional financial system makes the bank rich using your money and pays you next to nothing in return. At Living Wealth, we believe in challenging the status quo. After all, most of those conventional tools only seem to make someone else rich. Let us show you how to become your own bank. Visit livingwealth.com/bank on yourself. You'll receive instant access to what we call the beginner's course. This free, in-depth, easy-to-follow course teaches people how to create and profit from infinite banking. We not only discuss the philosophy and principles behind infinite banking, but also offer real-life examples to demonstrate how it works. Even participants experienced with infinite banking often tell us how they learned a ton too. It's worthwhile regardless of your experience level. Stop letting the banks and Wall Street dictate your financial future. Again, that's livingwealth.com/bank on yourself to gain access to the free course today. Now back to Nate and Holly.
Every other dollar that is real capital in your life should go into your bank and then be deployed out of your banking system. Why is that? Well, because we know that when the money exists inside the policy at a mutual life insurance company, it is only in existence to profit you, and it only ever will profit you, because there's no third party getting in their hands trying to take money out of it. There's a symbiotic relationship between a company and whoever owns that company. They rise and fall together. You can't separate the owners from the company from the success of the company. Some people think incorrectly still, and they're gonna have to get over it. And if you listen to this podcast and you have an argument against what I'm saying, okay, go do something else, because this is a fundamental truth and a fact that mutual life insurance companies exist for the benefit of their policyholders in the same way that banks exist for the benefit of their shareholders. This is just reality. You can choose to accept it or not. You can choose to argue with me or not. It's the reality, which means by default, by design, by nature, it is going to be a logical conclusion to say that banking from an institution that I own and profit from will result in better, or will have better results than if I bank inside of an institution that profits somebody else and I get the breadcrumbs at the bottom that fall off the table. This is the whole thing that Nelson Nash wrote the book Becoming Your Banker about. Now, of course, there can be more complexity and more different things going on per se, but this is fundamentally what infinite banking is really all about. Infinite banking is, if I can say it in one sentence, it's this: infinite banking is really all about relegating the banks to only do what they're good at doing. A conventional bank should only be doing in your life what it's good at doing, and you should build your own banking business to do everything else that you don't need just a payment facilitator to handle. Because, by the way, life insurance companies are not payment facilitators for you. You can't have checkbooks and online banking and debit cards and stuff attached from the insurance company itself. That's a banking, just a banking facilitating transaction that needs to be, of course, from like a checking account or something in the banking world. And so another thing to note, if you want to get good at IBCs, you have to get over the word insurance. You're going to have to get over the word insurance. Remember, the whole reason of understanding the philosophy behind it is so that you understand why dividend-paying whole life insurance policies issued by mutual companies present a unique financial reality that happens to check all the boxes that would be required in a better banking system. Now, the fact that it's insurance is kind of a side benefit. Like the fact that there's a death benefit is just like as Nelson Nash would just say, it's a banking business with a death benefit thrown in for good measure, which I've always found humorous but very true. And inside these policies, it has to be a better place for capital to be stored up and deployed. It just so happens to be that it is. By default, by the nature of the way behind the curtain the things are set up to be. And then inside of that contract that you have with the insurance company, you have some rights that make it extremely powerful. One is obviously the right to take a policy loan against 100% of your cash value at any time with no approval or application process whatsoever. That is a huge checkbox for what would be a great banking tool. The same thing, the right to take withdrawals from it or partial surrenders, of course, is there, but the right to take policy loans is a huge, huge deal. That what we've mentioned is that it's the only place in the world that offers an interest-only line of credit for life. That's a very unique financial tool that, as if you were your own banker, you would definitely appreciate that. The reason I bring this up, I'm going to bring this up a few more times in the coming episodes, is that I still talk to people that have capital in banks, and yet they say they've become their own banker and they're practicing this concept. And I think that there's got to be some sort of logical disconnect happening, or something is going on to where they believe they're doing something that they actually haven't fully been doing. In other words, you'll talk to somebody and you'll hear they're putting in premiums, but they've got $100,000, $200,000 in their personal bank account system, and then they've got, they may own a company as well. They're entrepreneurs, and they've got $500,000 sitting in the bank at their corporation. And you're sitting here thinking like, I thought you wanted to get out of the banking world at large and into your own bank so you could make more money. And I thought that's what we're trying to accomplish. But maybe there's been some sort of disconnect of what you felt like the infinite banking is really all about. Maybe you got caught up in the idea that infinite banking is just it's just a diversification thing. Like, I'm just going to put some money in policies and set it aside for later. And if I need it, I need it. And the loan thing sounds cool, and paying me back sounds cool, and all this stuff. It is cool, by the way. I'm not trying to discount that. It's fun, even if you don't really transfer to the new paradigm. But here's my issue. The issue is that I talk to people all the time, existing clients, prospects, or people especially from other agencies as well that have listened to the show and they kind of want to talk to me, and to get maybe some more advice because maybe they just like the podcast and they're learning a lot and all sorts of these things. And what I'm bringing up is you find out there's got to be some sort of logical disconnect where they may not be they may not be using the policies to accomplish what infinite banking is really all about. In other words, they are storing capital still in banks. when they actually are already in the banking business. And I think they would give lip service to the fact that the capital is better off in their own bank. But there's some sort of disconnect. This is why we've talked about it many times. I'm going to keep beating this into the ground, because there's oftentimes disconnect in policy transactions. There's disconnect in the flexibility of premiums. There's disconnect on the classification of premiums. In other words, people put them on the income statement and they belong in the balance sheet. There's so many disconnects going on in the world that you have to get over to switch to a paradigm. So in the next episode, in light of this, if it is true that you believe that dividend paying whole life insurance policies is a better reservoir to build up and deploy capital, number one. So you have to get to that belief. In other words, if you're brand new to this, or even if you've been doing it, you have to say, do I believe? The answer to that question is yes. In other words, if I say, client, do you believe that having capital built up in policies is better than capital built up in bank accounts? And if that answer is yes, okay, that brings us to the next thing. Do you believe that it is better to deploy capital from policies as opposed to building it up and deploying it from bank accounts? If the answer is yes, those are two fundamental IBC questions that you have to come to the answer to, of course. So if you believe that, then the third thing, how do I practically, in a practical way, in my life, in a logical, conservative, strategic way, how do I get out of the paradigm I'm in, which is using banks as a capital reservoir? How do I practically and strategically transition my life to where my capital is being accumulated and deployed from policies appropriately, and so that I can simply relegate the banks to becoming essentially payment facilitators? How is that going to happen? Like, what is the best and easiest way to switch paradigms to where I only use banks as payment facilitators and I use policies as my capital reservoir? And the thing about a capital reservoir is where you're storing up most of your deployable money, your liquid, safe, deployable money. And so inside of a capital reservoir, the idea would be, of course, every capital transaction should come out of your capital reservoir. So a capital transaction is typically higher expense things, whether it's cars or whether it's investments or whether it's homes or whether it's business equipment or whatever it is. All of this is called capital transactions. And you should at least build IBC to be big enough to handle all of your capital needs, your capital transactions. At least. You can build it to where it's actually big enough to start handling some of your expense needs as well. It is possible to do that. It kind of brings you back to the 4 stages of IBC commitment that I've talked about, that as I keep bringing up, if you don't get on board with that idea, and that is not, you're not firmly set in understanding the difference between the 4 stages, the saver stage, the capital builder stage, the entrepreneur stage, and the lifestyle stage. If you don't understand what I mean by those, you need to go back and listen to episode 160. If you even want a deeper dive than episode 160, you need to go to our YouTube channel or our website and go watch the webinar, The 4 Stages of IBC Commitment, so you can understand the 4 stages. What I'm trying to bring up is everyone should at least build their banking system to be big enough to where it becomes the capital reservoir for both their own personal life, their business, their corporate life, and their investments. That is what IBC wants to be, and then you can relegate the banks to only be doing what they're good at doing, which is facilitating your expenses, facilitating your transactions. So you would leave maybe 1 to 2 months of operating capital inside of a bank account, a checking account, and you would move all the rest into your own bank, which is by default is going to be a better place to build up, store up, deploy, use capital. And that's what it's really all about. That's what infinite banking is all about. All that to be said, next week's episode that's going to launch, I am going to dive into what I believe. And I have discovered it actually fairly recently. I've been living this, but I haven't described it to people. What I believe is the best way to help you set up your life to where you can enter this new paradigm and be comfortable with the new idea. In other words, you can believe that all of these things I said was true and still not be comfortable doing the things it takes to actually build out the banking system appropriately. That's fine. So me as a consultant in your life, I would offer some ideas for how to become more comfortable with the becoming your own banker idea. Many times it's getting over some fears and getting over some things, but also if you just practically set things up differently, I think you'll be aided. So I'm going to do that next week. And to do a quick review, just really quick, remember, infinite banking is trying to solve a problem that banks created whenever they started to essentially become very poor capital reservoirs, and they started to focus mainly on payment facilitation, and we still use them as capital reservoirs as opposed to just simply transaction facilitators, which is really what they're good at doing anyway. We ought to be finding a new way to do banking, both for you individually and for your corporation and for your investments. There should be a better place to build up and deploy capital. That's what infinite banking is really all about, becoming your own banker. Becoming your own banker as much as possible. The issue you find is that people will build up into capital inside of a bank, and they've got all these loans with the bank. And I'm just like, do you not know how much money the bank is making off you? They're making, like, you talk to businesses who have loans with the bank and are storing huge amounts of capital in bank accounts, and I'm just like, man, they love you. They're making a killing off you. You're their best friend. Wouldn't you like to find another way to get out of that? Here's the idea. Your capital is generating a large profit already. Your capital is generating profit. The question is, how much of the profit are you actually getting? Are you getting a piece of it, or are you getting all of it? If you're getting a piece of it, let's move into a place that's going to produce for you all the profit that your capital makes comes back to you, essentially. And it's just, by the way, mutual life insurance companies work. There are no other stockholders in the company. As a policy holder, all the profit that your policy makes is going to benefit you in the form of interest and dividends inside the policy. And then, of course, there's going to be a little bit left that they put into their capital account to make it a safe place to store wealth. I mean, that's just how it works, whether you choose to believe me or not. Whew, I've been talking for quite some time, but all this to say, infinite banking is one of the most logical transitions. If it's complicated, it's because you have likely forgotten the goal. Like, you've forgotten what we're doing. We want to become our own banker. Life is better when you have a whole bunch of liquid capital that's all yours contractually. You can access it at any given moment in time. It's very profitable to you. And on top of that, you can use it to get rid of the clutches of the bank and get out of debt with them if you so choose to, and only use banks to do what they're good at. Facilitate your transactions and borrow money from them if you need money to do deals, and also remove yourself the issue of being forced to borrow money from banks. That's another thing that IBC is trying to solve. You should get into a position where you only borrow money from banks when you want to, when it makes sense for you. It's called good debt. You should only use debt whenever it expands your business, allows you to make more investments. When it's good, secure debt to you, use the banks. In other words, you start to transition from banks making money off of you to you making money off of banks. And you do that by getting your capital out of the bank, because they love you if you have capital with them. You build your own bank with it. You use your own bank for most things, and you only use the bank to facilitate transactions and to access good debt. In other words, borrow money from them whenever you can make a profit above it. And that is the becoming your own banker strategy in a nutshell. Once again, by the way, I wanted to say this before we close down too. I know that there are a lot of people listening to this show on YouTube, on Spotify, on Apple Podcasts. And as you can tell, we're really devoted to producing high value content through this show. And if you're enjoying it, it really does mean the world to us. If you would leave a like or subscribe on YouTube, or a rating and review on Apple Podcasts, or whatever it is, just because that's what algorithms like. I mean, I wish I didn't have to do it. I wish that everybody could hear this show and get the value from it that you're getting. And we prefer to organically expand the audience, not to do paid advertising and marketing and all that gimmicky stuff to try to manipulate. We just want this to be of value to you. If it is of value to you, we would greatly appreciate a like or a review or a subscribe on the various sources that you download this content from. It would mean the world to us. So thank you so much for joining me once again on Dollars and Nonsense. If you follow the herd, you will be slaughtered.
One last thing before we go. Start your journey towards financial security and wealth today. Visit livingwealth.com/bank on yourself. Upon completing the course, you'll have all the information you'll need to see if infinite banking is right for you. Again, go to livingwealth.com/bank on yourself.